It's 2:14 a.m. Eastern Standard Time, and something catastrophic just broke in the silver market. COMEX futures just printed $71 per ounce, a violent $8 gap from yesterday's close, while the March-May spread exploded to 520, nearly triple what it was 12 hours ago. That's a 22% backwardation in a market that's supposed to arbitrage itself flat. Dealer inventory dashboards are flashing red across major bullion sites. Low stock, allocation delays, premium adjustment pending. The physical premium over spot just hit 480 on serialized bars. Screen prices show orderly trading. Dealer sites show panic. While paper traders celebrate the rally, the real metal is disappearing from vaults at a rate that suggests someone knows exactly what's coming. This isn't a squeeze brewing. This is a trap that's already sprung, and most paper holders don't even know they're caught yet. At 3:02 a.m. Eastern, Shanghai opened and the entire arbitrage mechanism disintegrated. The spread between COMEX futures and Shanghai physical blew past every circuit breaker that was supposed to contain it. COMEX showed $71. Shanghai physical dealers posted offers at $75.50 with no takers because there was nothing to sell. The normal flow works like this. When COMEX runs hot, physical metal ships east to capture the spread. Traders buy in New York, sell in Shanghai, pocket the difference. That's how the global market stays balanced, except the metal stopped moving. Shipping lead times that normally run 3 weeks were being quoted at unavailable. One major Shanghai dealer's website updated at 3:17 a.m. their time with a single line. All 1,000 O's bar inventory allocated. New orders March delivery only. The arbitrage traders were still placing their usual bets. The metal they were counting on to close the trade was already gone. This was the exact signature of 2008's palladium crisis, except faster and bigger. You need to understand what backwardation actually means when it hits 22%. In a normal commodity market, future delivery costs more than immediate delivery because of storage, insurance, and financing. That's called contango. It's the default state. When it flips, when nearby metal costs more than distant metal, that's backwardation, and it signals one thing: physical scarcity so severe that holders won't sell at any normal premium. They're pricing in the risk that metal might not be available later at any price. By 3:47 a.m. Eastern, COMEX March contracts were trading 520 over May. To put that in perspective, a 2% backwardation is considered stressed. 5% is crisis territory. 22% is a market screaming that the paper system has decoupled from physical reality. Futures traders holding long contracts were celebrating. They're up 11% overnight. But if they try to take delivery, they're about to discover that the warehouse receipts they're counting on might not convert to actual metal. The dealer inventories that are supposed to satisfy delivery obligations have already been drained by buyers who saw this coming and moved first. The comparison to 1997 and 2008 would be comforting if it were accurate. During the 1997 silver squeeze, Warren Buffett accumulated 130 million ounces, and the COMEX scrambled to find metal but ultimately delivered. The system bent but didn't break. In 2008, palladium backwardation hit 30% when Russian supply chains froze, but the crisis resolved when fresh metal arrived from South African mines. Both times the paper market suffered, but the physical market eventually supplied. This time the variables are different. Post-2021, regulatory pressure has pushed major banks out of commodities market making. Liquidity providers who used to bridge arbitrage gaps have exited. The shock absorbers are gone. Global silver inventories relative to industrial demand are at a 15-year low. And unlike 1997 or 2008, this isn't happening in isolation. It's happening while Shanghai is 12 hours from implementing new precious metal settlement rules that could fracture the global market into separate pricing zones. The system's not just stressed, it's operating without the redundancies that saved it before, and the clock is ticking. By 4:12 a.m. Eastern, the divergence between paper and physical had turned obscene. COMEX screens showed 71.40, up 860 from the previous close, a big move, but tradable, liquid, normal order flow. Pull up any major bullion dealer's website and the picture was completely different. One site listed American Silver Eagles at $83.50, a $12.10 premium overspot. Another showed 1-ounce bars at $79.80 with a note, "Orders placed today ship late March, subject to availability." Serial numbered 100 O's bars, the kind institutional buyers actually use for delivery, were listed as "notify when available" across 4 major dealers. The retail premium chaos was one thing, but the institutional market was where the real story was hiding. Lease rates, the cost to borrow physical silver for short-term delivery, had spiked to 18%, annualized at 4:20 a.m. That's higher than credit card interest. It means the people who have metal won't lend it at any reasonable rate because they don't believe they'll get it back. While COMEX futures traders were buying the breakout, physical buyers who actually needed metal for industrial use or delivery obligations were getting quoted prices 15% higher than the screen, or getting no quote at all. Here's where it gets insane. The arbitrage that's supposed to connect these markets is simple. If COMEX is higher than physical, you sell futures and buy metal. If physical is higher than COMEX, you buy futures and sell metal. The spread collapses, the market rebalances, everyone makes a few basis points. Except at 4:35 a.m. Eastern, that trade stopped working. COMEX was printing $71.60. Physical dealers in Singapore were posting $76.20 for immediate settlement, a $4.60 premium that should have instantly attracted arbitrage capital. But the metal needed to close, the trade wasn't available. Dealers who would normally supply that flow were posting allocation-only notices. The futures sellers who were betting on mean reversion that the spread would narrow were about to learn that mean reversion requires two-way flow. When physical supply dries up, the futures price doesn't converge down to reality. Reality converges up to futures. And if you're short futures expecting the spread to collapse, you're about to get destroyed. One Singapore dealer updated their site at 4:41 a.m. Premium pricing in effect until inventory replenishment. ETA unknown. The arbitrage traders kept selling. The metal they needed to deliver kept not showing up. Let's talk about what allocation only actually means. It's dealer code for, we have metal, but we're not selling it to you unless you're a priority client or paying a price we haven't posted yet. At 4:55 a.m. Eastern, inventories on COMEX-approved warehouses stood at 287 million ounces. Sounds like a lot until you realize that's barely 2 months of global industrial demand, and 40% of it is allocated to existing delivery obligations. The available inventory, metal that's actually for sale, was closer to 170 million ounces, except it's worse than that. Of those 170 million ounces, roughly 60 million are held by long-term investors who aren't selling at $71 or $81 or probably $91. They're holding for structural reasons, inflation hedges, currency insurance, geopolitical tail risk, which leaves maybe 110 million ounces of metal that could theoretically come to market at the right price. Meanwhile, industrial users consume 550 million ounces per year. Do the math. That's a 10-week supply cushion, and it's draining in real time. One London dealer's inventory dashboard, publicly visible, showed their serialized bar count drop from 847 to 420 between 2 a.m. and 5 a.m. Eastern. That's not normal volatility. That's liquidation. While New York futures traders were still analyzing chart patterns, the physical market in Asia had moved into pure panic mode. At 5:18 a.m. Eastern, 6:18 p.m. in Shanghai, a major Chinese dealer posted an update, all March delivery slots filled, April delivery conditional on supplier confirmation. Translation: we've sold metal we don't have yet, and we're not sure we can get it. The same message appeared on 3 other dealer sites within 15 minutes. This is the nightmare scenario for anyone holding paper exposure. You own a futures contract that says you're entitled to 5,000 ounces of silver. You go to take delivery. The exchange says your metal is in a warehouse in Delaware. You call the warehouse. They say it's allocated but available for withdrawal. You arrange transport. Then you get a call. Actually, that metal was already claimed by another contract holder. We can offer you a cash settlement at current market price. Except current market price is now $73.50 and climbing, and you bought your contract at $63. You thought you were hedged. You're not. You're exposed to a price that's rising precisely because the metal you were promised doesn't exist in available form. And the people who do have metal aren't selling. They're waiting to see how high this goes. At 5:47 a.m. Eastern, the lease rate curve inverted completely. Overnight silver leases, loans of physical metal for one-day settlement, were pricing at 22% annualized. One-week leases were at 19%. One-month leases were at 15%. That's the opposite of how it should work. Longer-term loans should carry higher rates because of increased risk and opportunity cost. When the curve inverts, it means the market is pricing in immediate, acute scarcity that might ease over time. But nobody's betting on it easing. The inversion was steepening. By 6:02 a.m., overnight leases hit 26%. The people who borrowed metal last week to sell it short, a standard hedging trade, were now facing a choice. Buy metal at 73 plus to close the position, or roll the lease at 26% and pray the scarcity breaks. Some of them were trying to roll. The lessors weren't offering renewal terms. Return metal or cash settle was the message going out, which meant forced buying into a rising market with no natural sellers. Every short covering trade pushed the price higher. Every price increase made the next short more desperate to cover. This is the classic squeeze loop, except it was happening in the physical market and the futures market simultaneously. The mechanism that's supposed to prevent this, arbitrage between the two, was offline because the metal needed to arbitrage wasn't moving. Here's what nobody saw coming. Shanghai's new settlement rules weren't scheduled to take effect until 6 p.m. their time, 7 a.m. Eastern. But at 6:15 a.m. Eastern, rumors started circulating that the implementation had been moved up. No official confirmation, just whispers on dealer networks and trading desks. If true, it meant that in less than an hour, physical silver trades in China would have to settle in yuan-denominated accounts with Chinese custodians. No more dollar clearing, no more international arbitrage through standard channels. Essentially, the Chinese physical market would decouple from COMEX pricing. The spread that was already at $5.20 could go to $8, $10, $15s. There'd be no mechanism to close it. COMEX would show one price, Shanghai would trade at another, and anyone caught holding paper contracts expecting global price convergence would be stuck. At 6:23 a.m. Eastern, COMEX March futures gapped to $74.10 on volume that looked like pure panic covering. The people who understood what Shanghai decoupling meant were buying anything they could get their hands on. The people who didn't were still analyzing whether this was a technical breakout or a fundamental shift. It was neither. It was a market structure failure happening in real time, driven by regulatory changes most traders didn't even know were coming. Let's be very clear about what happens if you're holding a cash-settled paper contract when physical supply vanishes. Your contract says you're owed the settlement price on expiration. The settlement price is determined by a reference index, usually an average of COMEX closing prices over the last few trading days. Sounds safe, except if physical metal is trading at a $12 premium to COMEX and climbing. Your cash settlement gives you $74, while the metal you thought you were buying costs $86 to actually acquire. You just lost $12 per ounce, not because you made a bad trade, but because the contract you trusted decoupled from reality. At 6:41 a.m. Eastern, this wasn't theoretical anymore. 3 major futures brokers sent out margin calls to clients holding short positions in silver. The margin requirements had been increased from 12% to 18% overnight, a sign that the clearinghouses were getting nervous about their exposure. If you were short 100,000 ounces, you just got hit with a demand for an additional $4,400 in cash by market open, and if you couldn't post it, your position would be liquidated, forced buying into a rising market that was already in a squeeze. Some traders were getting liquidated while still asleep. By the time they woke up, their accounts were blown out, and the price was $6 higher than where they'd been margined. At 6:58 a.m. Eastern, 2 minutes before Shanghai's rumored new settlement rules were supposed to kick in, the geopolitical dimension came into focus. If China's physical silver market decouples from dollar-denominated COMEX pricing, it's not just a trade, it's a currency war move. Silver isn't just an industrial metal, it's monetary metal, a store of value, a hedge against fiat debasement. If Shanghai can establish a separate yuan-based price discovery mechanism for physical silver, it fractures the dollar's dominance in commodities pricing. Other metals could follow: gold, platinum, palladium. Other countries could follow: Russia, India, Brazil. The COMEX London pricing axis that has controlled global precious metals markets for 50 years could splinter into regional blocks. And once that happens, arbitrage doesn't just get difficult, it gets geopolitical. You can't simply ship metal from New York to Shanghai to capture a spread if doing so requires navigating capital controls, export restrictions, and conflicting legal jurisdictions. At 7:01 a.m. Eastern, there was still no official confirmation of the rule change, but the market was trading like it had already happened. COMEX showed $74.80. Shanghai dealers, according to screenshots circulating on trading forums, were posting bids at $82.50 with no visible offers. That's a 770 spread, impossible to arbitrage, impossible to ignore, and proof that the global silver market had just fragmented. By 7:15 a.m. Eastern, the math turned inevitable. Global silver production runs about 840 million ounces per year. Industrial demand is approximately 550 million ounces. Investment demand, coins, bars, ETFs, adds another 200 million. That's 750 million ounces of demand against 840 million of supply, which leaves a 90 million ounce surplus, except that surplus includes recycling, which has collapsed as scrap dealers hold metal waiting for higher prices. It includes above-ground inventories which are already allocated, and it includes mine supply that's sold forward under hedging contracts at prices far below $74. The actual available supply, metal that could come to market in the next 90 days to satisfy new demand, is closer to 60 million ounces. Meanwhile, COMEX open interest in March contracts represents claims on 175 million ounces. Even if only 30% of those contracts stand for delivery, a conservative estimate during a squeeze, that's 52 million ounces of demand hitting a market with 60 million ounces of available supply. And that's before accounting for industrial users who can't afford a production shutdown and will pay anything to secure feedstock. The price isn't going to $74 because of speculation. It's going higher because the math doesn't close any other way. At 7:22 a.m., one of the largest silver ETFs posted an update, Authorized participants report metal sourcing delays. Creation suspended pending inventory resolution. That's code for the people who are supposed to create new ETF shares by depositing metal can't find metal to deposit. If you're holding ETF shares, you're holding paper backed by metal that might not exist in accessible form. At 7:34 a.m. Eastern, the spread that opened at 0.90 12 hours ago, the March-May backwardation that seemed like a technical glitch, closed at 640. That's a sevenfold increase in half a day. The COMEX inventory dashboard updated 287 million ounces registered but available for delivery now showed 81 million, down from 170 million at midnight. In 7 hours, 89 million ounces had moved from available to allocated. Someone was claiming metal faster than the system could replenish it. Dealer websites that showed inventory earlier were now displaying pre-order only across all product categories. The lease rate curve had inverted further. Overnight leases were being quoted at 31% annualized, if they were being quoted at all. Most lessors had simply withdrawn from the market, and Shanghai, still no official word on the settlement rule change, but the spread told the story. COMEX futures, $75.20. Shanghai physical, per the latest dealer screenshots, $83.90. The arbitrage mechanism that was supposed to connect these prices never showed up. The squeeze that was supposed to be impossible because there's always more metal had broken the assumption. There wasn't more metal, not in the time frame that mattered, not at prices the system could survive. The paper market was still trading, the physical market was shutting down, and the people caught between them, the ones holding contracts they thought were backed by metal, the ones short futures they thought they could cover, the ones trusting that the system would deliver because it always had, were about to learn what happens when a market goes from tight to broken. This wasn't the end. It was the beginning of the part where the math takes over and nothing stops it except price.